seen some of the other major street retail markets rise dramatically. So, I'm going to ask you a couple of questions. Cap rates obviously can be misleading because you've got a significant mark-to-market opportunity, but what are you generally seeing in terms of where these types of assets are trading from a cap rate perspective and from an unlevered IRR perspective?
So I think it's important to distinguish between stabilized assets where the leases are fully marked to market and they've just been reset to market, because you really have to throw out any cap rate on something that has an old lease or a near expiration lease. So if you take all of those 1 caps and 1.2 caps out of the equation, I think you're seeing a very simple effect of flight to quality capital that has been coming into 4 or 5 cities around the world, not just 3 in the US and maybe 2 outside. And that's where all of the money wants to be. And unfortunately or fortunately, that is driving pricing to levels that can be unrealistic for someone that thinks that they can improve that business plan by calling Rich and saying, hey, I just paid X cap rate for this, but I bought out the tenant, and now I need to charge you $2,000 a foot more than he was paying, and Rich hangs up the phone. So I think people, yeah, I think that has to be realized as a significant effect of capital. Capital is driving pricing to places that have a disconnect to the fundamentals of the health ratio of the retailers that they would like to lease to, and I think that's lost on some people, and I think that's creating danger in this market, and I have no problem saying that I think it is a dangerous time in this market to be buying into it.
I may spend 1 second on the health ratio. So I know you've been active, you bought a couple of things in London, obviously Miami, New York. From a retailer standpoint, Rich, you can comment as well. From a health ratio standpoint, how does New York compare right now to some of those other markets?
Right now, based on the tourists, it's a little bit more dodgy than usual. But I think it's across the board with every retailer. We're just seeing the same problems. The health ratios are a little challenged when the tourists dry up. They're challenged because of the size and the complexity of most of these rent deals to begin with. And when you have challenging markets with lack of tourists, it becomes even greater.
Better or worse than London right now, New York, in terms of retailers?
I luckily don't handle anything in Europe. South America could probably help you with the answer. I don't know what you go on.
I think that the Chinese tourist spend has been the biggest subject of discussion in the luxury retail world. And the macroeconomics of that Chinese tourist is, I think, not even understood in terms of the power of that spend and the strength of it. Where you're seeing them show up, you're seeing incredible amounts of sales being driven into the stores that they favor. So if you go to Avenue Montaigne in Paris, the Chanel store there looks like a flea market, and it's Chinese tourists buying the bags as if they were $10 handbags. That tourist is driving a lot of the decisions. North America has just begun to feel the effect of that traveler. 100 million Chinese tourists traveled abroad, mostly to Hong Kong, Macau, and local spots. Now Japan is getting a big benefit. US just increased visa timing from 60 or 90-day visas to 10-year visas. As more of those are issued, you will see a tremendous impact of the Chinese tourists, and I think that will be a landscape changer in a positive direction for the brands that can get in front of them and become important to them.
We're seeing that in Boston in particular with all the Chinese students in the top tier colleges that are there, and then the direct flights to Shanghai and Beijing that they started flying at Logan. I mean, it's become a much more interesting market than it was just a few years back.
So the one where Vancouver and San Francisco is being
Kind of different. So I know a lot of lenders in the room, and particularly those outside of New York, they often struggle with street retail financings given the high rents, the high prices per square foot, particularly on Fifth Avenue. What do you say to them?
So I think the lenders that are willing to dig deeper past price per pound should be looking at the fundamentals of the sales. And Westfield has some of the greatest properties in the shopping center business. I think our markets need to be looked at as shopping centers. And when you look at the metrics of the aggregate sales of Fifth Avenue, we believe that there's about $5 billion of retail sales being done on the stretch of Fifth Avenue from Rock Center to the Apple Store. And I was just looking at some stats of the top 5 malls in the country: Bal Harbour, Grove, Ala Moana, Aventura, and Caesars Forum. And they range somewhere between 3,000 a square foot for the best one and 1,500 a foot for the number 5. And if you look at the metrics of a market like Fifth Avenue with the aggregate $5 billion in sales, and just take our anchors versus any of the Fortress shopping center anchors, we have a $500 million Bergdorf, a $700 million Saks, we have a $300 million Tiffany, a $600 million Apple, and you start to aggregate those numbers. I don't believe that maybe the top 3 or 4 shopping centers combined can do those sales. I think their best Apple stores are 200 million, ours are 600, so you start to look at the ratio of sales, and then you really ask the question about price per pound and where your bets are best made. So I think it's a deeper dive into numbers rather than price per pound. That's an easy cop-out to not understand it.
I agree with Marvin on that one. I think that the way that people are evaluating, actually on this earlier, their store network, and it's about being on those streets and what importance does that store play in a global network when you're talking about Fifth Avenue. Because it is, now we spoke about digital, you can't just purely evaluate a store in relation to its performance in store over the cash register. You know, showrooming is a big part of it. The importance of the experience and going, you know, those customers, that customer that chose not to buy that day and went back to their country of choice and bought, well, they were connected to that store, and that store doesn't get equipped for that sale. But quite frankly, it was part of that network of the sale. So I think as technology increases, the value of stores need to be recalibrated, and it's not purely about its sales potential, which is always will be a driver, but there's further important factors.
Also, Mike, in New York, when we're laying out a retail expansion plan for new retailers that come here, you know, we have been able to ascertain that in New York you'll have sales 2 to 3 times as strong in New York as you have in any other city in the United States. So as a result, you also, because of how spread out New York is, you could have 4 to 6 stores in New York. You don't have to have just 1 or 2. So New York presents a lot of opportunity that a lot of other cities don't present.